So here, when we pivot to what is happening in the second segment, we want to look at, what are the probabilities of a rate hike? And it's interesting because when you look at the probabilities, there's an assumption that nothing really happens in the first Fed meeting, or in the one that's coming up. But then when you look at the probabilities as we get into November, it's not as clear. It's something where there's a bit more of an assumption that there might be a rate hike, and I think a lot of that is gonna pin on what happens in August. Now, the problem, which is what we've been talking about, is that inflation has reaccelerated. Now, you saw a little bit of it in July, but again, the comps get easier in terms of where we were against year over year as we continue to compound on a month over month basis. So it's an issue when you look at, they need to get in front of, or their target is to get in front of inflation, but yet inflation is now reaccelerating over the next, let's call it 2 months. And then September is going to be, okay, have things quieted down a bit, or are we just sitting at this elevated level? Now, because of diesel, because of the way some of those benefits fall away, it's going to be a little bit different. Now, I thought this was an interesting chart looking at the start of the hiking cycle and the start of the official recession. And right now, we've been raising rates for 17 months. So when you look at the amount of months since the start, you can see that the average is 22 months. So when people are like, we're not in a recession yet, it's like, no, we're not. But let's look at some of the drivers. Let's look at where are we heading over time. And is it going to be in a growth projection? Is it going to be kind of a stagnant, or are we going to get some of this slowdown? Our view is we get some of that slowdown and then things stay stagnant for a much longer time because they're going to have to keep things tighter. Now, one of the things that we're going to compare back to is 1974 to 1978, and then that 1978 to 1980, because you saw these big pivots, from 70 at the top of 74 through 75 and 76. And you started to see this I should say from 75 through 77, you saw this cutting, but then you had that reacceleration of inflation, and that's what caused this massive increase in rates from 78, bringing in Volcker and putting us at that peak into the 1980 component, as we saw going into 1980 and then again all the way into 1981, which we're going to talk about in a little bit. But the FOMC minutes showed that there's still a hawkish bias. So inflation is still well above the committee's longer run goal, and the labor market remaining tight. Most participants continue to see significant upside risk in inflation, which could further push that policy higher. But some FOMC members are becoming a bit concerned about the impact on the restrictive policy. But again, there's still a lot of capacity there. A number of participants judge that with the stance of monetary policy in restrictive territory, risk to the achievement of the committee's goals has become more two-sided. But when you look at the different pieces between inflation as well as where things are in general, it's difficult. You get a problem when you're looking at how things are setting up on a jobs front as well as an inflation front. So here, when we start looking at the leading economic indicators came in at negative 0.4 month on month versus the estimate of negative 0.4. So again, we're still on a leading indicator side. Things aren't as bad, but they're not much better. And that's something that we're going to talk about more next week as well, because you're starting to look at where that leading indicator is showing. And when you look at it, on that right chart, you can see that, the leading economic indicators have come down. Now they're kind of flatlining. And this is what we were trying to describe when we looked at 19. So remember, as we've talked about, and for those that were reading our insights at the time, we were bearish starting July 2019. And you can see why. Those leading indicators were showing some of those problems. We got a nice little reprieve, and then things started to get a bit worse again. But one of the interesting pieces in 2020 is that massive drop. You got this huge drop, but then a nice rebound. What we've been saying is that things are going to slow down, not get much worse, but not get much better either. And that's showing, again, that real GDP piece where those leading indicators are negative, but they're not really getting much more negative. It's like things are getting, they're less bad, but they're still bad. and it's still pulling some things down. So then when you start looking at the 1-year default rate for U.S. loan buyers has soared to 4%, surpassing the 2.7% pace of delinquency for high yield bonds. It's the first time in 30 years that the clip of loan defaults led junk bonds by such a margin. So remember, as we were talking about going back to where we were in the debt wall and that maturity wall, well, you still see a lot of pressure. You still see some of these issues coming, which again is leading to some of these pressure points, which is not going away quickly. But then you look at CPI, and this is why I thought this was a great chart, looking at inflation from 1966 to 1982, and then looking at it from 2013 to 2023. And here's that important pivot point where in 76 you saw this slowdown in inflation. And the Fed was looking at this and saying, this is great. We're in front of inflation. Inflation is slowing. Therefore, we have the ability now, before we get into a recession, to start cutting rates and bringing things back down and making sure that we're comfortable. Now, what happened? It reaccelerated and reignited the inflationary push, which, again, we had a war going on. We had just come off the gold standard. You still had a lot of issues on commodities with the lack of investment, with the embargo that was still there. Obviously, it had started to go away at this point. But when you look at these impacts, that created this view that, we need to provide some help, and we got in front of inflation. It's going to continue to improve. And then there was a hard pivot. And then that created that increase and that acceleration from 78 on. And the Powell's looking at this and saying, okay, well, how do we not make the same mistakes? And how do we learn from this period? How do we learn from what Volcker had said? And the idea is stay higher for longer. Now, there is more room to do another 1 to 2 rate hikes, but where we differ the most with the market, because let's be fair, another quarter point, another 50 basis points, not a huge deal. But when you look at it in terms of staying at that level for 12 months, for 18 months, that is a big deal. That is not what the market is expecting. The market is expecting more of what we had in 76. We're going to get rates up. Inflation is going to improve. We're going to cut rates back down. But again, we've seen that fail, so we're not going to. The goal is to avoid that pressure point. So then, when you start looking at, well, what are people doing? Well, U.S. money market assets have reached a new record of $5.5 trillion. When I was at Morgan Stanley, I was helping the money market desk, because we went from investing at Morgan at the time, that specific desk, about $600 billion to about $1 trillion, just over $1 trillion in overnight risk. And that was in that 07 period. And that gives you an idea of when we had this massive explosion. And it's typically because there's a lot of fear and people want something safe. And this is not a good situation when you look at how the consumer is viewing risk in the market, is viewing spending. And this is why I relate it back to where we were in 08, but it also shows the amount of liquidity that still sits in the market. Everyone keeps talking about, M2's coming down, therefore recession. Look at all. It's like, no, there's still a lot of work to be done because we've been easing for so long. And when you look at real yields, real 10-year yields, as well as the nominal yields, you get an idea of where the pressure points are. So the 10-year Treasury yield moved up to 4.28%, highest since December of 2007. The real yield, which is adjusted for the break-even inflation, moved up to it pulled back a touch from when I grabbed that, to about 1.96%, which is the highest since July of 2009. So when you look at this in general, and roughly 75% of outstanding treasuries will mature within the next 5 years. So when new bonds are issued, as well as we're rolling bonds, you're rolling at a higher rate. Therefore, your interest expense goes up, and the pressure to the tax revenue is only going to increase. But these two pieces are also very important for how you strike emerging market debt, how you strike high yield debt, how all these different loans. And this is when you start looking at what is the market pricing in, the market is pricing in a bit more fear, more inflation. and you need to be compensated for that risk. And that's something that is going to be a bigger pressure point. And this is a reason why the Fed would pause. But for those that read our article, when I said when I put together that the Fed has lost control of rates, this is what we were referring to. For so long the Fed was reactionary to rates, and now we're in the same position where the market is telling them that rates have to go up, and they're pricing that in at this point, and you're starting to get a steepener again, and that is a problem. When you start looking at some of these fears, a bear steepener for those that just to clarify, and you're getting some of these problems on growth, and this is going to hinder things more. Now, a quarter point additional, sure, it'll maybe move things up a bit, but you're starting to get that priced in because there are these issues that are sloshing around. So then when you look at capitulation and repositions, on the real estate side, you see that investors are continuing to sell more. In the US and the EU, commercial real estate still the most likely credit event. China real estate concerns have eased, but again, just based on when this was struck, I can guarantee you that this is going to reverse a bit and Chinese real estate is going to become a bigger fear. But when you look at the US, again, everything is correlated and connected in different ways. The stocks are ignoring the leading economic data. There's still this view where stocks are safe, they're inflation protected, protected. We still have the Fed put. The Fed's going to is going to cut rates. And what we're here is saying is that even if we're wrong and the Fed doesn't increase rates, we don't believe we're wrong that they're just going to keep them here. And because of all of the issues that we've seen, and now when you look back to another thing that could cause a pause is the bank term funding programs usage reached another peak last week. And this is the important component used to help backstop small banks. Now, as we did a show on it, and was it 5 months ago, looking at the issues in the small bank world, we said most banks were not prepared for the yields we had been predicting since 2020. Was that yields were going to go up, they were going to lose control of where yields were going to go, and everybody tests for low yields but not an increasing cycle. A lot of these banks fell asleep with their hedge books, and now they're overexposed and they're tapping into this program. So while we may pick on China, it's not just China that has an issue. There's a lot of places that have these issues that aren't going away. Now, when we start looking at global growth, when we look at the shipments from the Cass index, you can see that the shipments are slowing. Again, moving right below where we were in 18 and trending further down towards that 19 side, which is what we had been highlighting, that we've seen some slowdowns, we've seen some pressure, and we did get some of that benefit. We had some pulled forward, but now as we're coming towards the end of back to school, we're not going to get this big uplift in ordering, and that's reflected in rates, which have started to bounce just a bit, but bounce higher. But again, it's just they're not going to continue to go down. We're getting towards that point. And if you look at diesel prices, fuel oil prices, well, prices are going to go back up because that is a straight pass through. So then when we start looking at some other pieces of why they will raise rates, well, PPI is a leading indicator for CPI. July PPI went up 0.8% year on year versus the estimate of 0.7. Core went up to 0.2 versus the estimate of 0.1. And then when you look at it, core went up 2.4% versus the estimate of 2.3%. So that's a reacceleration. And this was in July. And remember, July didn't start to reaccelerate until really the second week, and then started to pick up steam. August started off hot and is continued to get warmer, to heat up, and we're at August 17th. So even if we get a cool down, well, you've had 2.5 going on 3 weeks now of things running pretty aggressive. So then when we start looking at finished goods, well, finished goods inflation rebounded in July to 1.1% off recent low. And then in month over month terms, PPI inflation came in at 0.3 versus the estimate of 0.2. Core came in at 0.3 versus the estimate of 0.2. And it's important to look at now that reversal off of June. And one of the reasons why we were saying that, based on all of the leading indicators we saw, you were going to get a bounce. It wasn't June weakening and then July was weakening. We saw this acceleration, and this is just the data proving confirming what we saw. No signs of material pickup in finished consumer goods portion through July 3rd. Month annualized change remained right at this 268, in that negative. But look, it's going sideways, and that's what we were saying, is that it wasn't. Everything isn't going to continuously go up. It's going to get to a point, pull back a bit, but then stay elevated. And then when you look at the service component, it increased in July at the fastest month-on-month pace since August of 2022. Services is the biggest driver and biggest component of the U.S. economy. So you're showing an increase in PPI at a massively accelerating level for what represents about 70% of the U.S. economy. That is not going to bode well, and another reason why the Fed is looking at this with a wary eye. Then you look at sticky inflation. Sticky inflation started to roll over a bit more decisively, while the flexible metric remains in negative territory but bounced. So you're looking at this, it's like, okay, we're making progress, but we're not there yet. Now you look at some of the PPI, you look at some of the leading indicators. We'll have more of them in the next segment when you look at what we're starting to see in Empire prices paid. When you look at Philly, all of them showing prices going back up. It's like, okay, well, then you look at home prices went back up. You're starting to look at some of these key indicators that is going to say, well, now's not the time. Then you look at inflation expectations from the University of Michigan. Expectations fell from 3% to 2.9, but 5 to 10% expectations fell from 3.4 to 3.3, still well above the target, which is something that the Fed is trying to drive home. Year-on-year change in CPI core services, super core reversed higher, hovering in 4% range, still too hot for the Fed. And going back, again, it's moving in the wrong direction. And it's starting to get difficult, and more reason why they're going to try to push this down. Core services remains largest driver of CPI. Year-on-year rate is now rolling over, while drop for core goods from peak has been more pronounced. And this is what we've been talking about, and now it's actually reaccelerated. Then you look at that PPI month on month, and then the core PPI. We just want to put into perspective how that acceleration. Now, it's only 1 month, but one of the things that we're seeing in August is hotter than July. So you're still it's not like it's a one-off and then it's going to go back down. There is follow through here, and that's what's the biggest concern. Because if you could say July was hot, but then there's all these leading indicators showing August is going to cool off, nothing to really talk about. But there's not. And that's where we that's where we look at what are the events and things that they're going to try to do. And this just gives you an idea of that momentum, where service momentum turned up. Headline is still kind of flattish, but the good side came down a bit. But when you look at some of the energy costs and some of the other costs, we've seen that pick back up. It'll still be negative. It'll just be less negative. But the goods, the service side is where they have the most concern, because it drives the largest part. Because goods is only, let's call it 12, 17%, where services is closer to 70%, which is why they have that weighting, and one of the things that they're going to want to focus on. So that's what we have for you in this segment. In the next segment, we're going to go deeper into what is happening on the retail sales, savings side, and where is the consumer going to be.